Hello and welcome to Investing Pool. Today's topic is how money is created and the dangers of money printing in modern-day economics. Money is a fascinating concept that has evolved over time. In its simplest form, money is just a medium of exchange that allows us to trade goods and services with one another. But have you ever wondered how money is created? Well, let me explain it using a metaphor. Imagine a swimming pool filled with water. The water represents the money supply. Just like the water in the pool, money can be created or drained depending on the actions of individuals and institutions. The primary way that money is created is through the process of lending. When a bank lends money to a borrower, they create new money out of thin air. This is because the bank only needs to hold a fraction of the loan amount as reserves, while the rest can be loaned out to other borrowers. This process is called fractional reserve banking. To understand this better, let's say you want to start a business and you need a loan of $10,000. You go to a bank and they approve your loan application. The bank then creates $10,000 in new money and adds it to your account. You can now use that money to start your business, pay your employees, and buy supplies. But where did this new money come from? It wasn't taken from anyone else's account. It was created out of thin air by the bank. This is the magic of fractional reserve banking. Of course, there are limits to how much money banks can create. They need to hold a certain amount of reserves to ensure they can meet the demand for withdrawals from their customers. But the fact remains that lending is the primary way that money is created in our economy. While fractional reserve banking can be an effective way to create money and spur economic growth, it can also lead to inflation and economic instability if not managed properly. In modern-day economics, central banks play a key role in managing the money supply and maintaining economic stability. However, the irresponsible use of money printing by central banks can have negative consequences for the economy and society as a whole. When central banks print money, they essentially create new money out of thin air and inject it into the economy. This can be done by purchasing assets, such as government bonds or corporate securities, or by directly lending to banks. The goal of this process, known as quantitative easing, is to increase the money supply, lower interest rates, and stimulate economic growth. However, the dangers of money printing lie in the fact that it can lead to inflation and a loss of confidence in the currency. If too much money is printed, it can lead to an increase in the money supply, which can lead to inflation. Inflation is when the general price level of goods and services in the economy increases over time, making it more expensive for people to buy things. Furthermore, the process of money creation can also lead to asset bubbles, where the price of assets, such as real estate or stocks, can become overinflated due to an excess of available money in the economy. When these bubbles burst, it can lead to financial crises and economic downturns, as we have seen in the past. Therefore, it is important for regulators and central banks to carefully monitor and manage the money supply to prevent these negative consequences. This is why central banks use tools such as interest rates and reserve requirements to manage the money supply and ensure economic stability. So, why do central banks resort to printing money in the first place? One reason is to stimulate the economy during a recession. By injecting more money into the economy, central banks hope to increase consumer and business spending, which in turn can create jobs and boost economic growth. Another reason is to control inflation. When the economy is growing too quickly, and demand for goods and services outpaces supply, it can lead to inflation. Inflation erodes the purchasing power of money, making it more expensive for people to buy goods and services. By printing more money, central banks can increase the supply of money in the economy and reduce inflation. However, there are risks associated with printing money. One of the most significant risks is inflation. While printing money can help control inflation in the short term, it can lead to higher inflation in the long run. This is because as the supply of money increases, each unit of money becomes less valuable, leading to higher prices. Another risk is the devaluation of the currency. When a central bank prints too much money, it can lead to a decrease in the value of the currency relative to other currencies. This can make imports more expensive and reduce the purchasing power of people who hold the currency. Furthermore, printing too much money can lead to economic instability. This is because excessive money printing can create asset bubbles, where the prices of assets, such as stocks and real estate, become overinflated due to an excess of available money in the economy. When these bubbles burst, it can lead to financial crises and economic downturns, as we have seen in the past. Despite these risks, some central banks have resorted to printing money in recent years. For example, the U.S. Federal Reserve has engaged in multiple rounds of quantitative easing since the 2008 financial crisis. The European Central Bank and the Bank of Japan have also implemented large-scale asset purchase programs. While these measures have helped stimulate economic growth and prevent a deeper recession, they have also raised concerns about the long-term risks associated with printing too much money. As investors, it's important to be aware of these risks and monitor the actions of central banks around the world. In summary, printing money is a tool that central banks use to stimulate the economy and control inflation. However, it also poses significant risks, including inflation, currency devaluation, and economic instability. As investors, it's important to be aware of these risks and monitor the actions of central banks around the world to make informed investment decisions.